Most investors think buying an ETF means they are diversified and safe, but some of the most popular ETFs charge hidden fees, hold overlapping assets, or are dominated by just 5 stocks. This video reveals 8 ETFs you should reconsider and 2 that actually do what ETFs promise. We're counting down from number 8 to the single most dangerous fund on this list, starting with a Wall Street darling that turned billions in hype into billions in losses. 8th place goes to the ARK Innovation ETF, a fund that promised to deliver the future of disruptive technology directly to retail investors. At its peak in October 2021, RKK managed $71.5 billion in assets, fueled by relentless marketing and a cult-like following around its manager, Cathie Wood. But as the hype faded, assets under management collapsed to just $28 billion by the end of 2023, a staggering loss of over $43 billion. The fund charges a hefty 0.75% expense ratio, far higher than broad market exchange-traded funds, and its portfolio is anything but diversified. The top 10 holdings make up nearly half of the fund, with Tesla alone accounting for more than 10%. High turnover, averaging 43% per year, adds to the cost drag. When a single stock like Tesla drops, RKK's net asset value takes an immediate hit, magnifying losses for long-term holders. The gap between the fund's marketing and its actual structure is stark. Concentrated bets, steep fees, and a rapid trading have turned a Wall Street darling into a cautionary tale. For investors, the lesson is clear: celebrity branding and promises of innovation can mask serious risks that devastate long-term returns. Number 7. ProShares Ultra S&P 500, better known as SSO, offers investors a promise that sounds almost irresistible. Double the daily return of the S&P 500, it says. But beneath that pitch lies a mathematical reality that most retail buyers never see. SSO resets its leverage every single day, which means the fund's long-term performance is shaped not just by the market's direction, but by the volatility along the way. Over 3 years, SSO delivered a striking 118% total return, outpacing the S&P 500 by 85%. Yet, during the market turmoil from 2022 to 2023, the fund's maximum drawdown reached a staggering negative 81.35%. The culprit is volatility decay, a compounding effect where daily swings erode returns, especially in choppy markets. Tracking error is another hidden cost, spiking above 2.5% in volatile months. The fund's expense ratio is 0.87%, far higher than that of traditional index ETFs. Regulators have taken notice. FINRA's regulatory notice 0931 explicitly warns that leveraged ETFs like SSO are unsuitable for long-term investors and require careful suitability checks. For those seeking a reliable core holding, it's a cautionary tale. Leverage amplifies not just the upside, but the risk of catastrophic loss. Investors looking for true long-term growth should focus on broad, low-cost, unleveraged funds that align with the market's actual performance. Number 6. iPath Bloomberg Diversified Commodity ETN, better known as DJP, introduces a risk that most ETF investors never see coming. DJP is not a fund that holds a basket of commodities. Instead, it is an unsecured senior note from Barclays Bank. That means every dollar invested is essentially a loan to the bank, with returns tied to the Bloomberg Commodity Index. The danger becomes clear when the bank's credit is questioned. On February 15, 2024, S&P Global Ratings downgraded Barclays senior unsecured debt from A+ to A. DJP's price dropped 6.3% in a single trading day, falling from $38.21 to $35.81, even as the underlying commodity index stayed flat. This was not a market move, it was a direct reaction to the bank's downgrade. The ETN structure means no physical commodity holdings, just a promise from the issuer. If Barclays faces further credit stress or, in a worst-case scenario, defaults, DJP holders could be left with nothing, regardless of how commodities perform. The fund's prospectus spells this out, but retail investors rarely read the fine print. While tracking error over the past year was modest at 0.27%, the real threat comes from outside the commodity markets. The Lehman Brothers collapse in 2008 set the precedent for how quickly ETN holders can be wiped out by issuer failure. For investors seeking commodity exposure, the lesson is stark. An ETN can implode on a credit event, even if the underlying assets are stable. True diversification means understanding what you actually own, not just the index, but the counterparty risk hiding in the structure. Number 5. The Global X Super Dividend ETF tempts income-seeking investors with headline yields that routinely approach 9%. But beneath the surface, this fund reveals a classic yield trap. High distributions mask steady capital erosion. SDIV tracks the Solactive Global Super Dividend Index, targeting the world's 100 highest-yielding stocks. The result is heavy exposure to distressed companies, especially in utilities and real estate, where payout ratios often exceed 80%. Over the past decade, the fund's total return stands at negative 4.3% despite its impressive advertised yield. That is not a rounding error. It is the product of a shrinking net asset value as dividend cuts ripple through the portfolio. Telecom Italia slashed its payout by 30% in 2022. Banco Sabadell followed with a 20% cut in 2023, and Suncor trimmed 15% the same year. More than 30% of SDIV's holdings have reduced or suspended dividends in the past 12 months. The expense ratio at 0.58% further drags on returns. For investors lured by the promise of high income, the lesson is clear: yield alone is no defense against a falling share price. Over time, capital loss overwhelms the cash flow, leaving long-term holders with less than they started. True income security comes not from chasing the highest yield, but from disciplined exposure to broad, resilient markets. Number 4. Invesco QQQ Trust is often pitched as a gateway to tech-driven growth, but the reality is a portfolio that is anything but diversified. QQ tracks the Nasdaq 100, yet nearly half its assets are locked up in just 10 stocks, including Apple, Microsoft, Nvidia, Amazon, Meta, and a handful of other mega-cap names. In 2015, the top 10 represented 44% of the fund. By 2021, that figure surged to 55% before easing to 48% in 2024. This concentration means QQ's performance is tethered to the fate of a few giants, leaving investors exposed if just one sector stumbles. The fund's expense ratio is 0.2%, double or triple the cost of broad market ETFs, such as VTI or IWB, despite offering about 70% overlap with those portfolios. Investors who already own a total market fund gain little extra diversification by adding QQ, but pay a steep premium for the privilege. The lesson is clear: even plain vanilla index funds can hide concentration risk and unnecessary fees behind a familiar ticker. Coming to the top 3, the VanEck Junior Gold Miners ETF ticker GDXJ exposes investors to a specialized kind of risk that can erupt without warning. GDXJ tracks an index of small-cap gold miners, but the rules designed to prevent any single company from dominating the fund can backfire when market conditions shift. In June 2024, U.S. Gold Corp's weight surged to 22.3% of GDXJ's portfolio, breaching the strict 20% ownership cap set by the index provider. That breach triggered a forced rebalance in July, cutting the holding back to 19.9% in a single event. For a fund built on thinly traded junior miners, these abrupt, rule-driven trades can send shockwaves through the entire portfolio. Liquidity dries up fast in this corner of the market. When GDXJ is forced to sell, prices can swing wildly, pushing losses onto unsuspecting investors. The lesson is clear: what looks like a diversified bet on gold miners can quickly become a high-stakes gamble on index mechanics, especially when fund size overwhelms underlying liquidity. In this environment, even a technical rule can set off a chain reaction that punishes long-term holders. In second place, the iShares MSCI Brazil ETF brings a different kind of risk to the table, one that most U.S. investors never see coming. EWZ is built on the promise of tapping into Brazil's growth story, but the reality is that currency depreciation and state intervention have quietly gutted returns for more than a decade. Since 2011, the Brazilian real has collapsed from 1.95 to 5.3 per US dollar, a staggering 172% depreciation. For investors holding EWZ, that means an average annual currency drag of about 4.3% year after year, eating away gains even when local equities rally. The story does not end with the exchange rate. Nearly half of EWZ's portfolio is tied up in state-controlled giants: Petrobras at 13%, Banco do Brasil at 8%, and Vale at 7%, adding up to 42% of assets exposed to direct government control. Policy swings, political crises, and forced dividend changes can hit these companies overnight, overnight, leaving investors with little recourse. The result is a fund that looks diversified on paper, but in practice is hostage to both a weakening currency and unpredictable state policy. For anyone looking to build long-term wealth, ETFs stands as a warning. International exposure without currency discipline and governance safeguards can silently destroy capital no matter how well the local market performs. And finally, in first place, ProShares ultra-short S&P 500 stands as a stark warning about the dangers of inverse leveraged exchange-traded funds in the hands of retail investors. SPXS promises a triple inverse return on the S&P 500 each day, but that promise contains a mathematical trap. The fund resets daily, so compounding and volatility eat away at returns far faster than most investors realize. In 2023, while the S&P 500 gained 15%, SPXS plunged 31.8%. That outcome was not just disappointing but devastating for anyone holding on. The pain was even sharper mid-year, with a peak drawdown of 45% by June. This is not a rare event. It is built into the structure. Most retail investors hold these products for weeks, not hours, exposing themselves to volatility decay that can wipe out capital regardless of market direction. Forum after forum is filled with stories of investors who bought SPXS as a hedge only to watch their positions erode in a rising market. The lesson is clear. Inverse leveraged exchange-traded funds are not a shortcut to safety. They are a fast track to catastrophic loss for anyone who misunderstands their mechanics. For long-term investors, the only real protection is broad, low-cost diversification, not complex products that punish the uninformed. Across all 8 examples, one urgent truth stands out. Complexity, hidden fees, and concentrated bets undermine the very promise of ETF investing. Marketing gloss hides structural flaws that punish long-term investors. In the end, broad, low-cost diversification, not financial engineering, is the only edge that consistently protects and rewards.